bond yields tank, the oil service sector booms, and a key Bitcoin moving average. I quantify it all on today's REKTelligence Report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush. This is the All Markets Report for Monday, February 16th, where I quantify across asset classes with an eye to the week ahead. Now let's get right into the key themes for this week. And number one is U.S. yields dropped quite sharply last week. Is this bullish or bearish for stocks, for the S&P 500 specifically? Afterwards, I'm going to answer that today. The oil service sector price boom. What's history have to say about the recent huge OIH, that's the ETF, gains? And lastly, Bitcoin's critical moving average is the king crypto's performance after closes below this SMA. Instructive. We'll find out today. All of that ahead. Stay tuned. I'm starting with the credit market this week, kind of. You'll see what I mean in a minute. First of all, let's take a look at the 10-year Treasury note yield. This is a weekly chart. And let's step out for a minute before I quantify anything. Look at this large-scale pattern. The data here on this chart starts in 2022. And you see since then, we've seen this quieting down of yield, continually getting narrower and narrower on this large-scale chart. And yet last week, if you go to the right-hand side, you see a very negative bar right down to the lower boundary of this symmetrical triangle. Looks like we may be about to break below this lower boundary. Now, the percentage change on the 10-year note yield was negative 3.57% last week, and may soon, as I mentioned, drop below the lower boundary here. So this is happening. This is very important. This is happening amid constant talk of large foreign holders of U.S. assets, particularly bonds, dumping them and diversifying away from the U.S. That is quite the conversation right now. And yet yields are falling as bonds move higher. So quite an interesting contrast, a little bit of dissonance there. Let's quantify this action. All right, so TNX, that is the symbol for the 10-year Treasury note yield. And if TNX, or the 10-year yield, drops 3.5% or more in 1 week by the S&P 500, that is the test that I'm running here. And this is results with a 1-week hold, very short term, from 1963 to the present. And total P&L here, over 243 trades. So this is small average trade, even though it's positive. The total P&L, 174 and change percent. Max drawdown defined by TradingView is 28.33%. Again, 243 occurrences of this over that pretty lengthy time span, 63 to the present. And the hit rate or profitability is 62 and change percent. That's 151 out of 243. So definitely well north of a coin flip. And the profit factor here is 1.54. For those new to profit factor, I'd like to remind you that it is the sum of gross gains divided by the sum of gross losses. So 1 would be break even. There's no edge to the upside or downside. But a profit factor of 1.5 and change here or higher, of course, is positive. It means that there is more profit than loss in the total back test here. So it's a jagged equity curve. This is not some fantastic trading system. I wouldn't be excited to trade this, but there is 1 week out, no sign of concern, historically speaking, for the S&P 500 under this scenario where the 10-year yield drops so sharply in a week. Let's move out to actually, we're going to stay on 1 week, and let's flip the script. What if, and this did not happen last week, but I just wanted to show you this. What if it had been the reverse? What if the 10-year yield had jumped 3.5% or more inside 1 week? That would mean that bonds were selling off and the rate or the yield was climbing, the opposite of what happened last week. What if that happened and we bought SPX and the same thing otherwise with a 1 week hold? You can see there's no edge at all. It's slightly negative since 1963, basically noise. There just is no positive edge, very slight negative edge, greater drawdown. Profitability is only 55 and change percent. Profit factor is below 1, so slightly more loss, of course. So we don't have this scenario right now. We have the opposite scenario. So let's go right back to it and extend the holding time, right? Let's go back to what happened last week, but buy the S&P 500, hypothetically speaking, with a 1-month hold, 4 weeks here. And you can see total P&L is pretty sharply higher now, over 1,000% over this long time span. Drawdown is a little bit greater. Total instances 163. The hit rate 65.6 and change percent, and profit factor nice, healthy 2.495. Now you can see some jagged drawdowns in this equity curve, like over there during COVID. But you see an otherwise pretty nice equity curve up and to the right. Let's extend this now. Let's go out 2 months, 8 weeks. And we see even greater P&L, 1,864 and change percent. Drawdown does grow a little bit, right? There's more time for variation and variance and volatility and drawdown when you have a longer hold time, of course. 8 weeks, as mentioned, 118 instances. Profitability or hit rate grows to north of 72%, and profit factor is just almost to 3, not quite, 2.91 and change, and a slightly smoother equity curve as well. So now how far we go out with this test just based on 1 week's Treasury note yield dropping sharply is debatable, but let's continue with the exercise just to see what this looks like. 12 weeks out, total P&L grows 24.47%, pretty impressive drawdown. It's about what it was before, 96 instances with that 12-week hold. And hit rate is 3 out of 4, essentially 75%. Profit factor about the same as we just saw. Let's move out further, 26, half a year hold. And we see total P&L 3,450. So again, just based on this 1 week's sharp drop in yields, stocks seem unfazed when you go out half a year. Drawdown is sharper naturally. Total trades 60, same hit rate of 75% that we just saw, and profit factor now north of 4. Let's just do 1 year. And we see just a phenomenal total P&L from 63 to the present. A lot of years there. Drawdown's about the same, 37 instances. Hit rate 91.89%. So, and profit factor of over 5.5, which is awesome. Nice looking equity curve here. And yet there really just is no concern based on this sharp yield drop. Now, I will also quantify yields again if we get a break below that lower boundary and a sharp move lower. That should set up some interesting queries, and we'll take a look at that as well if that plays out. Time for a stock market update, and I'm going to start with breadth. Now, I covered this a week ago in my last All Markets report, kind of in some depth. This is just going to be this one slide, and I want to compare last week's numbers to this week. So you can see the latest market day a week ago was Friday, February 6th. At the end of the week, you saw stocks above their 20-day moving averages inside the S&P 500. So we're looking at just the top of the market, the blue chips, S&P 500, and stocks above their 20 MA. It was majority of them, right? 66.5%. Stocks above their 50 MA, 67.7%. This is again a week ago. Stocks above their 100-day moving average, 66.7, perfect 2 out of 3. And stocks above their 200-day moving averages, such a widely watched and simple measure, 67.1%. So breadth was really looking good, right? That's a sign of health. Let's go to this latest data point, Friday, as I'm recording this on Sunday. And the 13th of February, we saw stocks above their 20 MA that had slipped down to 61%. Is this a big dip? No, little deterioration. What about stocks above their 50 MA? Kind of the same thing, 62.4% now. Above the 100 MA is 65.4, not a big change. And stocks above their 200-day moving averages, 64.8% as opposed to last week's 67.1. So obviously markets pull back a little bit. You're going to see these breadth numbers slip. Is this any cause for concern? No, I quantified it a bit. Not interesting enough to share. That will change. There will be moments where the breadth is quite negative typically and very interesting to share, or exceedingly high. And that's also quite interesting. So I'll bring you that in the future as those conditions unfold. But here, just a little deterioration, nothing that I'm too concerned about at the moment. Time for a crypto update. And once again, I'm going to start with the king crypto, which of course is Bitcoin. It sets the tone for the entire market. And I've looked at Bitcoin's price action, its degree of stretch percent, crypto sentiment with the fear and greed index, which I quantified. So a lot of different sides of the diamond. And this week, I'm looking at Bitcoin and its relationship to its 52-week simple moving average, or SMA. So on screen, you see this orange moving average, and pretty much most of the time that Bitcoin closes below this critical MA, bad things seem to happen, right? You see the crypto winter of 2018 on the lower left-hand side. You see COVID there in 2020, that down spike below the 52-week moving average. And you see the 2022 bear market, which most asset classes sank, with the exception of the dollar, which rose, and a handful of others, but most assets falling, stocks, crypto, bonds, and so forth. And you see most recently this close below the 52-week moving average here, either late last year or early this year. It looks like late last year. So the bull flag that followed, and then this sharp drop we've seen more recently. So I want to quantify Bitcoin's price action under this scenario quite simply. So here is the test. Bitcoin closes below its 52-week SMA and simply exit when it closes back above it. Quite simple. And the data is from 2011 to the present. That's the start of the good data, right to the current moment. Now, total P&L for this test on 14 hypothetical trades or instances is negative, right? Negative 43.37%. Drawdown is pretty steep there, 67.5% essentially. Again, 14 occurrences historically of this hypothetical scenario. And the hit rate is interestingly quite positive, 71.43%, but profit factor is below 1. This really illustrates right here as a side point that winning percent, which new traders think, oh, it wins all the time, must be great, is the least important metric typically. Depends a little bit whether it's a mean reversion system or a trend following system. Win percent has different significance in each scenario, but just generally speaking here, the hit rate or the profitable trades number there, 71.4%. Normally that's pretty good. Doesn't matter here. A 1-year hold after Bitcoin closes below its 52-week simple moving average. There have only been 7 instances of this since 2011. And the total P&L is positive. So with a year hold, and irrespective of it closing back above the 52-week SMA or not, we're not dealing with that exit now. We're just holding it hypothetically here for a year. This is a positive scenario historically. We don't have a ton of data. It's Bitcoin, it's crypto. We don't have a lot of data, even with Bitcoin, the most established peer-to-peer crypto. Drawdown is pretty sharp. No surprise. This is crypto. The hit rate is 71.43%. 5 out of 7 have been profitable a year later. And profit factor is excellent. It's over 2, right? Twice the profit versus the loss, simply stated. Let's look at a 2-year hold, and you see the total P&L just skyrockets here in this scenario. Again, it does include those early years. Drawdown's about the same, 4 instances with this longer 2-year hold time. 3 out of 4 were positive, and the profit factor is just phenomenal. Easier to have a high profit factor on fewer instances, but nevertheless, it's excellent at 8.68. Thanks for watching today's All Markets Report. And of course, stay tuned for Thursday's Edge Report. That's where I issue a video quantifying specific opportunities in stocks, crypto, commodities, and more. And for now, trade smart, live well, and cheers from the Caribbean.